Hey everybody, welcome to another episode of Keeping It Real Estate. My name is Dan Brisse. Today we're going to talk a little bit about the state of the market. There is a lot going on, as most of you know. We are in this moment in time where interest rates have shot up the fastest we've seen in the last 40 years. When is the right time to buy? When things are super high and it's really hot, like they've been over the past few years, it feels scary to be buying. You're always thinking, is this the top? Are we at the top? Now you transition, and here we have had interest rates rising for the last year, a little more than a year, and it feels scary to buy. Are we still going lower? Are we still going lower? And I think that's a common theme you find in investing is, when do you feel really, really great about buying? And, it doesn't matter when things are really great and markets are up, everyone's competing for deals. So it's hard to find deals, really is. When things are going down and things are coming down like they are right now, it's hard to make a deal work because your debt has changed and the sellers have expectations of what they, think their property is worth over the last couple of years. And although that's changing, it doesn't happen overnight. Put yourself in a buyer's shoes. If you're buying a deal and the market is super hot, for us, when we're buying these deals, you're going after them. Well, so are 15 other people, and you're in a best and final with 15 people. It's a challenging time to buy. Coming into the other side, when it's a downturn like a recession and you're selling a property, you're hesitant to sell at the price the buyer wants to buy it. We're selling a property right now. I feel like we're giving it away. We're still getting a really good return, and the investors are going to make really good on their money, which is why we're doing it. We want to put some liquidity back in our investors' pockets, but you feel like you're giving it away. And I can almost guarantee you the buyer that's buying right now is wondering, did I overpay? So investing in these markets is always challenging, and that's why we're focusing back on our criteria for underwriting. Get clear on your investing criteria and do not waver from your investing criteria. Hopefully your investing criteria is getting better and you continue to redefine what that is and make adjustments based off of your education and experience. Some of the things that we've changed over the year with our criteria is year built and location, 1 mile median income. It really the demographics dictate if we're going to even look at a deal. Is the property in a challenging market where it's very difficult to control and keep your residents motivated to pay rent on time? They always say you can change the property and we can re-tenant the demographic, but you cannot change the whole submarket. So at the end of the day, get into submarkets you guys feel comfortable with, get your underwriting in place, kind of debt you're comfortable with, and really hold to that. And if you stick to it, I'm confident opportunities will come to you, and your brokerage team and everybody in your team will get to know better what it is you're looking for when you're looking to buy deals, and they'll start sending you deals that fit more your criteria, which will make it easier for you to close deals. Let's get into a couple pieces that here we're just focusing on the state of the market. Jobs. I'm taking a couple headlines here that I read and we've read on our team over the last couple of weeks, and just wanted to bring you what we're seeing in real time. Unless you're reading this stuff every day, you're probably not going to get this detailed of information. But for those of you that are, this will be a nice refresher. In April, employers added 253,000 jobs, which just demonstrates that we still have a lot of resiliency in this market, even though we have rising interest rates and high inflation and a banking crisis. And I can tell you guys right now, we still see that. We still feel that. When we're looking for people to come and do work on our apartments, we luckily have contractors and vendors lined up. But on a day-to-day for me, if I'm trying to get work done, even at my house here, I mean, man, it's difficult to get people that are not 3, 4, 5 months booked out, and even get people to come and look at our job. So that's still a sign that you've got a lot of demand for people who still are spending money. Also, the unemployment rate reached a 54-year low of 3.4%. And that's partially due to 43,000 people leaving the labor force. I'm thinking the people who are leaving, you guys, because I think the big question everyone's asking is, where did everybody go after COVID? And I think a lot of people from COVID and pandemic that were in their baby boomer generation that are a little older just hung it up and retired. I think you have a lot of baby boomers that are retiring and leaving the workforce, leaving a large gap of employers and team members that were here just a few years ago. The government revised job gains for February and March by 149,000, and hourly rate wages rose at the fastest pace since July. That is not good news. That is not good news at all, that hourly wages are still rising at a fast pace. It just means they're still going to battle with inflation. And as long as inflation is around, it's going to be more uncomfortable for the folks who make a lower level of income. Inflation hurts everybody, but it hurts the people who make 50,000 and less by far more, or 100,000 to 50,000 more. The more you make, the less it affects you. But for those that are on a tight budget, you better have some increase of income. Otherwise, your living standards continues to go down and down and down. And unfortunately, that's a lot of residents and apartments. So it's more critical than ever to get your criteria right and make sure you're buying in a demographic you feel very comfortable with, and that the rents you're going to charge are 100% feasible on your pro forma rents. The Fed rate hike language has changed a little bit. I'm sure all of you have heard this. The Fed increased the Fed funds rate by 25 basis points, which aligned with their predicted terminal rate. The change in language at the meeting suggests a possible pause in rate hikes, with the focus on determining the extent of implementing additional policy. So they're starting to monitor. They're not just in that 75, 75, 75 focus anymore. There's obviously things going on in the economy with bank collapsing, which we're going to talk about more later. But there are signs that they may start to pause. And Chair Powell emphasized data reliance for future rate decisions, keeping the possibility of further rate hikes open. So didn't commit to a pause by any way, shape, or form. But you can hear by the way they're chatting and talking that they're more hesitant to continue to plow forward with interest rate increases, which obviously will change the market sentiment massively, and could be kind of a change in how we see things roll out over the next 6 to 12 months once they pause. Strong jobs data and inflation concerns. So a couple points here that we pulled out. Non-farm payrolls exceeded expectations, indicating a strong job market. More of the same of what we just talked about. Average hourly earnings surpassed forecasts, signaling positive wage growth. More inflationary talk. Despite high inflation, there is no clear signs of the labor force taking a hit, which is questioning the Fed's forecasted unemployment rate. I mean, to me, you guys, it's confusion. Like, hey, and this may be that we're in a completely new market. We went through a period of time where they created more currency than ever before in the history of America during COVID-19. We have folks who are in that baby boomer generation retiring. You start to flush a system with cash, and you don't have enough people to fill those job openings. You are going to have inflation, and it is going to be a challenge. Another piece to add to this now, the other side is you've got regional banking sectors and credit conditions where you've got some banks failing, as we've all heard about, right? So a pause in rate hikes provided relief to the at-risk banking sector. That's one of the reasons they may pause. They're in the middle of a rock and a hard place. Do you continue to have these banks collapse and put the economy into a downward spiral, or do you pull back a little bit and try to find a way to maybe ease some inflation and not cause complete catastrophe? Another point we are mentioning here, the upcoming release of the Fed's Senior Loan Officer Survey may reveal tightening credit conditions. Concentration of risk and use of backstop facilities by specific banks indicate positive signs for the broader regional banking sector. So they're very closely tuned in to what is happening in the banking system, and it has their attention. And I think that it does for good reason. I mean, I think about all of the people or all the funds you have in a regional bank. I'm concerned about those funds. We sent emails to those banks asking for proof of how solid, how financially strong they are, and how they're going to make it through this, unique environment with interest rates peaking. And I think you've got a lot of other people that have, I mean, if you own a business, having 250 grand nowadays is not that much money. Most every business has 250 grand plus. So you're not FDIC insured above 250K. So if you're not, how do you secure those funds to make sure that they are available when you need them? Let's transition a little bit to deals. What are we seeing in the market as we hunt for deals? We underwrote about 30 deals in the last 30 days. We offered on one of them that we are in best and final on. We're looking at maybe putting an offer in on a second one. We're on the hunt. And bottom line is the market right now, you guys, is in a safer state to buy, we feel, than it was a year ago or even a year and a half ago. Where we were a year ago and a year and a half ago is everybody and their mother was making offers with bridge debt. And when you have bridge debt, it just means that the terms are more aggressive and banks are probably allowing you to use more leverage. And at that time, rates were low to pay top dollar. We're just coming off this tail end of everyone buying deals and flipping deals and making all this money. So everyone's aggressively going after deals. Well, transition 1 year forward and rates skyrocketed like they did. Who saw that definitely coming? I'm not sure who all saw it. Maybe there were some people, but I know there's a lot of investors who we know personally who've been doing this a very long time who have bridge debt with variable rate loans. And what happened is as those rates shot up, obviously rates went. And if you had a variable rate loan and you didn't have a ton of cash or you didn't have a rate cap in place, and a rate cap, all that is it caps what your insurance rate will move to. So if you have a 1% rate cap, it'll move up 1%. And then above that, the insurance policy covers everything left. Above that. So you're probably in a good spot as long as you have enough time here, or you can accumulate enough capital to buy another one. But for those that didn't put a rate cap in, don't have a ton of liquidity, and their rates have now gone from 4% to 7 or 8%, they are in a very, very challenging situation. And that is when you start to have folks who bought those deals have to bring them out to market because they need to get out. They might get out and lose the investor's capital. They might just come out to break even, but that's where you're ideally going to start to see deals to pick up. But last year, you're hesitant to buy when things are up high because you're like, are we paying top dollar or are we over leveraging this deal? Now you come down to the lower market because we offered on a deal 1 year ago and the price went for 40 million. We offered 39 and it went under contract for 40 million. That buyer fell through. The deal did not go through. It is now back on the market for 30 to 32 million. And they're saying with being in best and final, about 32 million is kind of your number that it might take to get to it. Well, think about that. That's a 20% reduction. Last year, you're buying it with bridge debt, variable debt, over leveraged. Now you're buying it at 20% discounted price with fixed debt at 70% leverage. Your rate's higher, sure. But when you buy these deals, you are underwriting the rate you will be at to figure out your cash flow. Another thing to consider with criteria, guys, are you buying for capital gains or cash flow? We're all about cash flow. If you can buy for cash flow and you can have extra money every month accumulating, you will never be in a position to sell. Yeah, it's not as fun. Yeah, the market's not super pretty. Yeah, you've got challenges, but at least you can ride the storm and get through the other side and not have to give away and hyperly quickly sell your deal and take potentially a major loss in capital. So we are on the hunt for new deals. You're basically just using the new leveraged amount, which is what is affecting the price or the value of these deals. Again, the market's kind of counterintuitive. Last year, all these investors couldn't wait to get in. New deal, I'm in. Bridge debt, they didn't understand it. A lot of people were like, I didn't understand it. It was a variable rate loan. And jumping in. Now you've got deals that are coming out with low leverage fixed debt and people are hesitant. So you got to be a little bit like Warren Buffett says, when others are greedy, be fearful. When others are fearful, be greedy. We're starting to see signs that you should be a little bit greedy when you're at 20% of a discounted price with leverage reduced and fixed debt that you can sail through with conservative underwriting. How much lower would the market need to go for you to lose that deal? there would have to be a major catastrophe. So something to think about. All right, you guys, just to wrap it up, we examined the recent developments in the Federal Reserve's meetings and their impacts on the market. And despite rising interest rates, high inflation, and a banking crisis, the job market just continues to show resiliency with the addition of 253,000 jobs and record low unemployment rate of 3.4%. However, like we said, the concerns remain about the accuracy of the Fed's economic forecasts and the implications of a wage growth on inflation. And then the Fed's decision to raise rates by 25 basis points and the different language they're starting to use indicates a possibility of a pause in rate hikes in the coming months. So we're going to focus on the data, as the data will help us better see the future. I hope this episode helped you guys a lot. Continue to learn, continue to stay connected with the right deal sponsors, build trust with that deal sponsor, make sure you know, like, and trust them very well. And just keep your head in the game. This is the time for the folks that are prepared, that can spot opportunities, that have cash, that can massively move the needle. Most millionaires are made during major recessions. So the deeper we go, the more opportunity we should see. Have a great week. We'll see you next week. Take care.